Welcome to the OANDA Market Pulse Charting Analysis video. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, it's been a little while since we did our last video. I was out of the office last week, as I warned on the last video last Friday. So today I'm going to try and cover as much as I possibly can. I think we'll probably take a broad selection from the currencies space, take a couple of commodities, and then finish off with an indice as well. So we cover a wide range of instruments, but maybe the video won't be quite as long as the 3 videos I would ordinarily do on a Monday. Now let's start with the currencies. Euro dollar, we are seeing a continued surge high. Now we are seeing the benefit of these safe haven flows in the euro. We've seen it pop up towards this 113 levels, where it's currently finding some resistance, but to be honest, with the 110 being broke, 110 111 region being broken over the past week or so, really now I'm looking towards these 114.50 to 115s for the next major level of resistance. Now that's not to say we couldn't see some consolidation corrections along the way, but given the fact that we've seen that 110 or 111 broken, we've also seen it retested as new support, which is confirmation of the initial break, which makes me more bullish again. We're not seeing any indication of falling momentum on the MACD or histogram. For me, I think this 114.50, 115 is a very realistic target. It's a very realistic level for euro dollar in the coming weeks. These last couple of candles as well, nothing bearish about them either on the weekly side of things as well. Quite a bullish candle actually from a weekly perspective from last week. Cable. It's also looking a little, well, it's looking a bit bearish still to me at this stage. The reason being that, well, for one, of those two currencies, I would say the more risk-averse would be cable, and anyone that's followed the markets so far this year knows that the risk-averse play does seem to be very much preferred throughout January and February so far. But the fact that we've had this little correction in cable since towards the end of January, we did move up towards this 50 fib level around 146.60, at which point we have seen it rebound low. Now that is a 50% retracement of the move from those December 11th highs to the January 21st lows. We are seeing it pull down from these levels. Now this 143.50 to 144 level, which is prior support and resistance, is offering some form of temporary support, but to be honest, I do believe pressure does potentially remain to the downside here. Now the last weekly candle was looking very bullish, but the fact that we saw the move back up to these levels and we saw the pull back off these highs in a weekly close well below the highs and also below that prior support suggests to me that there isn't an enormous amount of bullish bias right now. Now I think this, I think this is going to be a key test between these two levels, 146.50 and around these 144s, 143.50, 144s. The first of those to be broken, I think, will give us a much stronger indication, because I think these are two very key levels now. Until 146.50 is broken, I see no reason to be particularly bullish in this cable. That's not to say it might not find a trading range, but I find it hard to be particularly bullish above those levels. Dollar yen is particularly interesting because the yen, of course, again is one of the currencies which has particularly benefited from these safe haven flows. Now, the result of this has meant that we've got this head and shoulders, or this kind of makeshift head and shoulders in dollar yen, which I've highlighted previously. Now, it failed at its first attempt to break below the head and shoulders, and the 89-week simple moving average, which we've highlighted on previous videos, has been a fairly decent level of support and resistance along the way. Now, it failed on the first 2 occasions to break below this level, but this week we have seen it tear below this level, now the neckline of this head and shoulders is debatable. It always is the case, especially when we do see these rising lows and these rising highs for the shoulders. Some people will choose to go off the ultimate low, which would be around these 1550s, these 115.50s, which has been broken at this stage. We haven't seen a weekly close, but it has been broken. You may want to use the slope of the line, although again it's not perfect on the shoulders either. The fact that the slope coincides with that big moving average, that suggests to me that this is the legitimate neckline as far as I'm concerned. And a move from these 116.50s to give us our conservative projection towards these 123.50s is around 700 pips. Now that takes us down to around 109.50. Now again, these are only just estimated projections, and the fact that that 109.50 coincides roughly with these 109.50 to 110 prior resistance level, key round number, key psychological level, suggests to me that this is going to be the conservative primary price projection for dollar yen, and this is where I think we could see ourselves trading back before too long, barring any central bank action from the Bank of Japan or the Federal Reserve prior to this. Again, regardless of the reason for it, I do think this is going to be primarily safe haven flow driven, but these 110 levels I think is going to be the next key level as far as I'm concerned, given the break that we've had already this week. Next chart is your Euro Sterling. Now, we have had a break of those prior highs. Now, in Euro Sterling, what was interesting was we had them move back towards these 75 to 75.50 levels. Again, these prior region of resistance turned support. Now, we didn't see a move all the way back to towards these levels. We did see the bulls really front run this move, which was quite interesting, potentially shows just how bullish the market is. Now, we saw it move back towards these prior highs, and these have now been taken out, which opens up now a move towards that next resistance, the prior towards this next resistance around potentially 78.70s. Now, for me, with the break of these 77.50s, I think really what we're looking at now is a move back towards these 80 to 80.50s, this prior region, this solid block of resistance that we had between June and December of last year. I do think we could potentially find some temporary support resistance around these 78.70s, given that we did on the last occasion back in January 2015, so it was throughout the June to December 2014, apologies, but this 78.70 was also support back in July of 2014, so we could see the pair find some resistance there again, and quite typically what you'll see when you see these support and resistance is support to turn resistance. So this was resistance here. If we see a move towards these 78.70s and we see a rebound off here, then I'd be looking back towards these 77.50s potentially for a support bounce with the bulls potentially coming in and then pushing towards those 80 levels. But for now, I'm looking at around these 78.70s for a potential resistance. If we don't see resistance, then again I'll be looking back towards those 80s, but this could be a potential level of resistance for this Euro Sterling pair. Next is Euro Yen, and we've seen some nice moves here again over the last couple of weeks, because we did see the descending trend line from the December 8th highs, December 8, 2014 highs tested once again. Now, once again, that provided resistance for this pair, as it has on a number of occasions during this decline. Now, what's interesting on this occasion, though, is that we've pulled back towards the 61.8% Fibonacci retracement level. That is the 21st of January highs to the 21st of January lows to the 29th of January highs. We've seen it pull back towards this level, at which point it's caught a bid. Now, this isn't just the 61.8 fib, it's also the prior resistance during this period throughout January. So the fact that we've caught a bid on that 61.8 Fibonacci retracement level opens up the potential for a move to the upside through that descending trend line for me. Now, that's not guaranteed by any stretch at this stage. That just makes me potentially slightly less bearish at this stage, which I would have been prior to that rate rebound. The interesting levels now is going to come around those 131.70s, maybe 131.50s. Again, prior region of support. Again, we've got that descending trend line, which has proven itself to be a key level of resistance. For me now, this is a battle between the 131.50s and the 128.50s. First to break for me will determine whether the market has turned more bullish or whether the bearishness continues. But the fact that we've caught such a strong bid at these 128.50s does make me a very, very cautious bear at this stage. Next up, sterling yen. And once again, this is one that I highlighted previously because we had this sell-off, of course, very strong sell-off in sterling yen. I've mentioned this flag formation previously. I'm not sure if we added a Fibonacci retracement level to this in the previous video, but it actually came back towards the 175-ish levels rather than a fib level. Now what makes this important is because, as I've highlighted on the previous videos, it's easier to see this on the weekly chart, but we've actually got again this kind of makeshift head and shoulders level. Now that 175 level is absolutely key because that's the neckline of the head and shoulders. Once we had the break of the neckline of the head and shoulders, this gave us two possible price projections. We had the conservative one, which takes the move from the shoulder down to the neckline and projects it lower, and we have the more aggressive one, which takes the move from the head down to the neckline and projects it lower. Now we haven't seen either of these levels hit yet, and again, from a fundamental standpoint, I am favouring a move to the downside because we're seeing so much risk aversion recently. The yen is very much seen as the risk averse trade compared to the pound at the moment. So the fact that we broke below this level made me really quite bearish. Now what makes that even better is the fact that that 175 level did turn into resistance, again confirming the move of that neckline. Had that broken above the neckline, that would make me believe that the head and shoulders was possibly invalid, and therefore I'd probably move on and ignore these price projection levels. But the fact that it's confirmed suggests to me that we do potentially have some more downside to come here, and we have had a sell-off from this. We saw a very nice actual technical move here. So we had the previous support turn resistance during that flag formation, and following the rejection at that level, we had an immediate break of that flag and a move to the downside. Now I do still believe, despite the fact that we have run into support once again around these 164.50s, even though we have caught a bid at these levels on this occasion, I do still believe that we potentially have some more downside to come in this. It'll be very interesting to see how this daily candle finishes. If this finishes as a hammer, for example, even better with a green head, that may suggest we're going to see another assault back towards these 175s, which would be extremely interesting, because what we'd be left with at this case is a short term or a shorter term double bottom, a break again. This would be the neckline of the double bottom as well as the neckline of the head and shoulders, and that would give us a very strong indication of what to expect next. Now, just because these double bottoms form, it doesn't mean they always complete. To complete, they need a break of the neckline just to not the formation of one, and preferably a close above. But at this stage, this is only where I think getting a little bit ahead of myself here. I still remain bearish, especially back towards these 160.80s, and unless we see a break of those 175s, I'm not inclined to believe otherwise. But a nice hammer candle here, particularly with the green head, would suggest we do have potentially some at least short-term bullish move in this pair. Moving on to commodities next, and I just wanted to highlight two commodities for you, gold and silver. Starting with gold, what's interesting here is the fact that we've got this longer term descending trend line again. This dates back to May of 2013. It's been tested on a couple of occasions, and that's been tested on a fourth once again. Now what's interesting is it got rejected at the first time asking around those 1200 levels, not only the descending trend line, but also a key psychological level, prior level of support and resistance as well. It was rejected the first time Vask, and we have seen another rally today. Again, the safe haven flows benefiting gold. Now we haven't, unless we see this broken, then I can't be too bullish on this. I'm not necessarily saying I'm bearish at this stage, because being bearish on gold in a bearish environment does seem quite ludicrous, and by that I mean bearish in gold. When I say bearish environment, I mean an environment in which safe havens are being preferred. Gold is typically or historically seen as one of your ultimate safe havens. So in a bearish environment, to be bearish gold seems quite insane, really. But unless I see this 1200 level broken, I can't be too bullish on it either. I do think we may potentially see some more pressure to the upside, and what really supports the fact that we may see some pressure to the upside is what we've seen in silver. Now in silver, we've got a similar descending trend line. The difference being the silver is almost like the more volatile younger brother of gold. We've seen this similar descending trend line, again going back to around August 13. But what happened is yesterday we saw a break of that descending trend line, and we saw a move back towards these 1540s, and we're continuing to see a bit of upward pressure here. But the important point is we saw this aggressive rally beyond the 1509s, and we saw a move back towards the 1540s, 1550s. 1550s, where it has run into a little bit of resistance around the 1550s. We are seeing some consolidation, but it still looks particularly bullish as far as I'm concerned, and the fact that we've seen a breaker here maybe suggests that we are going to see a similar break in gold, in which case I will become much more bullish on that as well. I'm going to wrap things up today with the DAX and what's, again, very interesting time in DAX, because I've highlighted previously. Actually, I'll start with the daily, because we've got a nice little technical move here going back to the previous video, because we saw this sell-off back in the DAX back towards these 9250s to 9300s, and then we saw some consolidation. Now, initially this looked like a little bit of a rising wedge, and we saw a break below the rising wedge. And this then almost kind of gave birth to a slightly less sharp rising wedge. But what was interesting here is we saw the break of the initial trend line, and I left this on there because the fact that we'd had these 3 points suggested to me that it was perfectly legitimate trend line. So what we effectively had was this really beautiful technical setup where we had the break of the initial trend line, then we had found support once again, then we had a retest of the prior trend line, so support turned resistance. It failed to break back above here, and then we saw the break of this new rising wedge. Very nice technical setup here. So the way that played out was very technical indeed. Now, what came of this was we saw another test of the 9250s to 9300s. On this occasion, didn't fare quite as well. We saw it's in an aggressive move lower, back below 9,000. We're now trading. We've traded as low as 8750. Now, what's interesting here, we're now around just below 30% off these highs from less than a year ago. That's a significant move to the downside. We've seen a break of the trend line now, which takes us back to the sovereign debt crisis lows in 2010. We've had a retest of some key resistance levels along the way. So this continues to look very bearish, and these last 2 weekly candles really are particularly bearish, especially when you consider that this one is only 2 days in. Now, the fact that this 8900 level could have provided some temporary support, having done so previously. At the moment, it doesn't appear to be doing a very good job, which brings my eyes back towards these 8350 to 8550 levels. 8350 to 8550, prior resistance, prior support. This is the next very important region for me. A break below here really takes out the lows from October 2014, and that gets us trading back at levels last seen in September 2013. We are looking back a long way at this stage, and if we're almost 30% lower at this stage, then just think of the significance of what a move back below 8350 would bring. But now with this level broken, I am potentially looking back at these 8350s to 8550s in the coming weeks. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Trade, which has a lot of great tools designed to help you with your trading.